kind of take a look at that as well, right at the word go. But the first trades any second now. There we have it. 100 points lower on the Sensex, about 730 points lower on the Nifty is what you have. 22,300 on the Nifty straight off the bat. The Nifty Bank will come up on your screen. That's down about 0.25%, 100 points. So 47,000, just under 47,500 on the Nifty Bank. You've got the Nifty Midcap Index, which is absolutely flat. And I think the Small Cap Index, which has lost 1.5% last 2 days, is maybe starting a little bit in the red. Yeah, that's actually down the most, 0.75% down on the Small Cap Index, which is where the pressure has been. Sonia is here with more rates. Sonia.
Well, thanks a lot for that. So, as you said, right, the Nifty is under a bit of pressure, down about 50 odd points. The real pressure seeping into the Nifty Bank, down about 126 odd points. Let's take it straight to individual stocks. JM Financial is the one I'm looking at. The RBI has barred JM Financial from financing against shares and debentures. 12.5%, 13% now, almost a 14% knockdown on that stock. Not looking good at all. Yesterday, you had IIFL Finance that was under pressure. Jefferies, in fact, has downgraded IIFL Finance to a hold from a buy and has cut their target price to 435 from 765. So IIFL Finance is seeing another 20% knockdown and big downgrades coming in this morning from Jefferies as well. So this is the pocket that continues to be under pressure. On the upside, NHPC is up 2.5% right now. The company has started work on their 1200 megawatt Jalaun Ultra Renew Power project. That's happening in Uttar Pradesh, so keep an eye out on that. MGL is the one that is down almost about 8% right now. Citi has downgraded MGL to a sell. The regulatory risks on the margins have gone up, so MGL not looking good at all. 9% knockdown now. Havels is the other one that I'm looking at. The company has said that they will now introduce kitchen appliances as well. Havel is up almost about 1.5%. LTI Mindtree news just came out a while back that there's a JV with Saudi Aramco that they have signed for IT services in the MENA region. So LTI Mindtree in focus. JSW Energy has signed 5 battery energy storage purchase agreements with Solar Energy Corporation. So keep an eye out on that. And in very interesting brokerage reports, Cello has been on our radar for the last couple of days. This morning, Cello World has seen a Kotak initiate coverage on the stock with an ad and a target price of 950 rupees. By the way, there's that Zomato large trade that has happened, which is below on your screen. Zomato's now down 2.5%. Antfin is a likely seller there. 2%, a little over 2% equity has changed hands, worth about 3,112 odd crores. So those are the stocks in focus. Otherwise, for the market, it's quiet with a bit of a negative bias. But really, the focus should be once again on JM Financial and IIFL Finance. Both stocks under a lot of pressure. Back to you.
All right. Thanks a lot for that, Sonia. So, Zomato, the deal got done. And even Samvada Motherson, that deal as well appears to have got done. So both those two are out of the way. Those are the deals that we were tracking. Just one data point I want to give you on the IIFL circuit. As of now, there are close to around 12 lakh shares that are traded. And there are close to 85 lakh shares still waiting to be sold. So, and they have been waiting to be sold at lower circuit. So that's another stock out there. MGL, the stock is almost at, lower freeze for, temporary freeze as we speak. Nimesh had brought us that standout brokerage out there. So, that stock is well down close to around 8%. That's Samvada deal, Motherson deal, both of them flashing for you on the screen. A few more notable big movers. Indiabulls real estate is down close to 7%. Massive volumes out there. Suzlon from a 50 rupee stock, it's come down to around 38.7. Big volumes out there. The stock is under pressure. Manappuram Finance is down close to around 2.5% as we speak as well. So some of these are the top volume buzzers today. Hexacom Tele listed yesterday. Good up move is what we saw out there. And today as well, big volumes, stock up close to around 6.5%. AB Fashion and Retail, since there was a conversion of those warrants out there, that stock is well moving higher as we speak. So those are the top volume movers.
All right, no, absolutely. The Motherson, Zomato, IIFL, JM Finance are the top 4 volume-led losers which are coming up for you on your screen. And I think we mentioned Suzlon is down another 5%. Muthoot and Manappuram is down 2.5%. I mean, it rallied, and we were talking about maybe it was a little overdone. Reaction was perfectly fine, but then markets overdid it, and I think it's basically completely reversed. It's back at day before yesterday's levels. Solar Industries is down 3%, 7,540 or so on that one. IGL is also down 3%. MGL is down 8%. IGL is down lesser, but 3% or so. Inox India is down about 3%, 1,160 on that one. There is Marico, which is coming up with about a 2% cut. You've got GIC RE down 1 3/4. And you've got to go down the list then to find more. IIFL Securities was also down sharply, but it's down only about 2% right now. And there is something like a Loda, which is down about 3%. Volumes are very thin, so you got to give it some more time. Inox Wind is down 5. So Suzlon and Inox continue to come off. The recent high on Suzlon was $50. It's now 38. On, of course, Inox, the high recently was about 628. It's under 500 rupees now on Inox Wind. On the upside, by the way, 2:1 market breadth. And this is what we've been talking about, broader markets losing momentum. And it's not the Nifty so much, it's broader markets and the small cap index, etc., which continue to deflate a little bit. 1% lower on the small cap index once again. On the upside, REC and PFC, there was that brokerage call, 3% on both those names this morning. There is NHPC, which is up 2.5%. And I can spot JM Financial, which is, Geo Financial, beg your pardon, which is up about 1.5%. It's the second biggest volume-led gainer. I was pointing out Manappuram down, but Muthoot is up 3% this morning. So 1400 plus, it stays there with the 3% pop once again. And yesterday's 60% higher listing, Exicom, is up another 6%, 6.5% at about 240 rupees.
I also wanted to just point out one stock, Updater Services. That stock actually, Motilal Oswal has initiated coverage on that stock and it's up almost about 3% odd. Updater, yes, there you have it, 3.5%. They have a buy, they have a target price of 465 on the stock. Now, this is one of the leading business service providers in India. They have integrated facility management, business support services, etc. So basically, sales audit, recruitment, BPS providers. And Motilal Oswal says that there's a unique opportunity to benefit from the long-term trend of outsourcing of non-core business operations. So this is another stock, 5% almost now.
On Muthoot, I think it's the core, gold financer out there, and the yield is closer to what the peer was lending at, close to around 18% or so. I guess that's working for them as well.
And gold is at a new high, so
gold is a new high, so that's positive as well.
All right, well, let's get Dheeraj Agarwal, Managing Director, Ambit Investment Managers. Dheeraj, good morning. Good to have you with us here. Thanks for your time. I guess we got to start with the RBI actions in the recent past. And are you, in your conversations with peers and other money managers, is that coming up as a bit of a question mark for NBFCs as a sector or not really?
Not really. I think it's very, very specific at this point of time. I don't think the whole sector will suffer because of that. But yes, one signal from RBI is very, very clear at this point that they are ready to take decisive action. So it's a clear message to the industry that please fall in line. It's also a clear message to the industry that if we are raising issues or concerns, please respond timely and take corrective action. So in some senses, I think the regulators do what they're supposed to do.
Okay. Dheeraj, but it's not so much about these individual stocks as much as it is about the general sentiment, right? At a time when the market is at an all-time high, now here comes the RBI cracking down on several sectors. It just gives rise to a bit of caution in the system, especially towards the NBFC space. Would that be your concern as well, that there would be this sentiment overhang and hence there could be some sell-off as well? And if yes, what should one be doing with the stocks that they own in this space?
No, I think if you look at RBI's warnings and RBI's red flags, it's been going on for a while. It's not very, very recent. RBI has been sounding alarms on multiple things. One is unsecured lending. Second is the high CD ratio of the banks and low levels of capitalization. And third is some of the specific actions which is taking place at this point of time. So there are a few spaces in the economy where RBI has been worried, and maybe rightly so. So will it dampen the sentiment a little bit in the near term? Perhaps. Will it change things materially? I don't really think so.
All right. Hi, Dheeraj. Good morning and good to see you in. What about the preference between basically large cap and small caps? Year to date in this fiscal, small caps, mid caps, they have been rank outperformers. However, in the last 30 days or so, the Nifty is outperforming. The Nifty Bank is outperforming. So at current reckoning, going by that, I think the mid-cap index itself is at a 30% premium in comparison to the Nifty's valuations. Would you deploy more money in the larger cap names?
It's best to take a stock selective approach, I think, to some extent. Mid-caps and small caps as a complete asset class, I think, looks slightly risky. There are individual stock picking opportunities in mid-caps which still exist. And that's the nature of the mid-caps. It's so diverse in terms of both sectors and business composition that painting them with a big broad brush is also very, very difficult. A lot of large cap companies have become, in terms of valuations, have become attractive and relatively better buys at this point of time. So for a while, it's possible that the large cap does a little better than the mid caps.
Let's share some names then, Dheeraj, if you could do that. What do you think is best place right now? The banking names, actually, they were underperformers. They are bouncing back. And there is valuation comfort because earnings cuts are not coming about there. And valuations are getting more attractive. Would banks be top of mind?
I would say banks is still a very, very diverse, diverse space again. So, I mean, for example, I like some of the PSU banks, I like one or two private banks as well, but not everything in the banking space. Because if you actually plot the individual fundamental metrics of the banking, you can actually plot them on sort of a curve, something near the top, something near declining. Few companies are still on the ascending mode. So 2 or 3 metrics to look for in the banking space at this point of time is, one is how is the CD ratio doing? So if the CD ratio is very, very high, which means the bank can actually struggle a little bit in terms of funding its growth. That's a little bit of a red flag for me. Second, one should also look at the valuation versus growth versus ROE, because all the large banks' ROEs are converging. So this year, all major 5 banks' ROEs will be within 100 basis points of each other. And hence, the valuation gap will also not be very, very high. So that's the other metric to look for. So these are the 2 key matrices that I look for in constructing a bank portfolio at this point.
Okay. I wanted your thoughts also on a couple of other sectors. By the way, I wanted to mention that some of these names like Tata Motors continue to inch forward after that big move yesterday that Tata Motors saw. There's an additional 0.5% rally. It's piling on the volumes as well this morning after, demerging of its passenger vehicle and commercial vehicle business. Dheeraj, very interesting, right? I mean, a lot of these large groups like the Tata Group are doing a lot of work to improve their balance sheet, to unlock value for shareholders, like Tata Motors, for example. Despite the rally that we've seen, do you think that more money can be put to work here?
I mean, I've liked Tata Motors for a very long time, and one of the primary reasons for that is the whole deleveraging story and the whole capital allocation corrective steps taken by the management and the company in the last few years. So they've focused their capital expenditure, they're focused on new model launches, they're focused on free cash flow generation. Domestically, the car business is doing really well. So I just continue to like it. I think they're doing the right things in terms of both generating free cash and now demerging to make the business structure a little bit more cleaner and clearer. Because that's one of the reasons why many investors didn't come into Tata Motors. They said it's a bit difficult to understand.
Okay, so, well, if you're talking about the markets, very, very flat right now. Not too much happening, but some of the stocks, we were just talking about Tata Motors, right? Even something like a TVS Motor has hit a fresh 52-week high. So that one is now at a fresh 52-week high. It's had a very good run this year, up about 13-odd%. ABB India is at a fresh 52-week high as well. And a couple of other names also sitting at fresh highs. So just wanted your thoughts before we let you go on, since we spoke about Tata Motors, any thoughts on the two-wheeler space? Do you like names like TVS as well?
We like it, but I worry a little bit about the valuations now. We like the two-wheeler space in general. That space is bouncing back after many years of volume struggle. In fact, even now, the volumes haven't crossed the 2019 peak. So there is some more runway of growth for the entire two-wheeler space. So yes, the short answer that we like the two-wheeler space at this point.
Okay, all right. We'll leave it at that, Dheeraj. Thanks a lot for joining in and talking to us about the market as well as the way forward. By the way, we were just chatting about Tata Motors. As we know, Tata Motors has announced its decision to split its businesses into 2 separate listed companies. But how will this impact its global engineering service provider group companies, which is Tata Tech is one of them. That's one of Tata Motors' key clients, contributing around 33% of revenues. Warren Kevin Harris, who is the MD and CEO of Tata Tech, joins us now to talk about that. Mr. Harris, good morning, and always good speaking to you on the channel. That's my first question to you, right? Because of this demerger that has happened, what is the kind of impact that it would have on your business? Because 33% of your revenues comes from Tata Motors, and now with this split, how will things change for you?
Well, first and foremost, thanks again for having me on the show. Always delighted to catch up. You know, we do very well when our customers do very well, and Tata Motors continues, I think, not only to lead the market here, but I think in terms of the global market, they're demonstrating, you know, through the various product launches, the direction that the industry has to take. I think the demerger announcement certainly positions focus for both the passenger vehicle organization as well as the commercial truck organization. And in the context of passenger vehicle, you know, the synergies that can be exploited between JLR, PV, and EV, I think are eminently now more achievable. And I think one of the exciting things for Tata Technologies is the fact that we are intimately involved in both JLR, PV, and EV. So we're ideally positioned to take advantage of the close working together that we expect to see between those various divisions.
So can you help us with some numbers? In Q3, you won 5 large deals in the quarter. This included one deal with over $50 million in TCV and another one with $25 million. How are the deal wins looking like in Q4? Is it as good as what Q3 was? And what is the deal visibility that you have over the next, say, 12 to 18 months?
Yeah, despite some of the more cautious rhetoric in and around the adoption of electric vehicles, from an ER&D perspective, you know, we're not seeing any slowdown in momentum. So the success and the deals that we were able to celebrate in Q3 has continued on in Q4, and we are at least from a deal signing perspective looking to have a very strong quarter. So we'll announce the details of some of the successes as we prepare for the Q4 earnings that we'll expect to announce sometime in the end of April, beginning of May timeframe.
All right. Hi, Warren. Always good seeing you. And thanks so much for joining in. Nigel on this side. You know, yesterday, Tata Technologies, the intermediate exchanges, that you'll have appointed Mr. Sukanya as the COO of the company. And he is, part of the TCS group. Any reason for that role? Is there any bigger collaboration between TCS and Tata Technologies? Wanted some rationale for this intergroup transfer.
Well, just on the appointment of Sukanya, we're absolutely delighted to welcome Sukanya into the Tata Technologies leadership team. Sukanya has not only run industry verticals for TCS, but more recently she's run delivery excellence for TCS and was appointed last year as the CDIO. And I think the experience that she has in terms of contributing to the success story at TCS and to supporting the pursuit of scale is something that we can leverage very effectively. You know, I think we've demonstrated the compelling value proposition that we represent. But as we pursue the target of $1 billion in revenue, we have to invest in the infrastructure, our systems and processes, and we have to put in place the platform around which we will drive scale. And I think Sukanya is eminently qualified to enable that for us.
So that's no bigger plan is what we want to clear out of the way between TCS as well as Tata Technologies. And I think you've answered that question as well.
Yeah, but I just one thing on that topic. You know, one of the things that the group chairman has consistently messaged is the importance of One Tata and collaboration. And so increasingly, we're not only working with TCS, but also with Tata Elxsi and Tata Communications to put together consortia propositions for the market. And increasingly, we're demonstrating success as a result of the synergies that we're able to exploit.
And you've said before, right? I mean, you overlap, compete, sometimes even collaborate. Kevin, great to have you with us here. Good to speak with you again. Prashant here. And you did, at that point, say that the chairman has said that find synergies within group companies. But since this Tata Motors split happened into trucks and cars, there is no other way to find synergies via realigning corporate structures or anything, right? That's a question which has come up in the past as well. We discussed this.
Yeah, there's no plans to integrate companies. There's no plans to look at any type of corporate restructuring. All that we're working on at the moment is leveraging the breadth and depth of the capabilities that the different companies represent to unify an integrated proposition for the market and specific target customers.
Just on that earlier point, Kevin, when you said that there is some caution on EV adoption, but on ER&D for EV, there is nothing. There's no slowdown. Is that a disconnect, or is that very natural? I mean, just a little bit.
It's really very natural, because what companies, our customers, are investing in today will define their competitive position in 3 and 4 years' time. And so the product development cycle plan of the customers that we work with is somewhat disconnected to the short-term ebbs and flows of the demand cycle. So we're very much riding the wave of EV adoption, and also the investments that are being made in connected services and software-defined vehicles. And as I signaled earlier, demand continues to build, and that's allowed organizations like ourselves to reinforce the momentum that we've worked hard to sustain over the last 3 or 4 years.
I just have a couple of more questions. 9 months FY24 revenues saw very good growth, almost 28%. Where do you think you can end the year? Will it be better than this? And also, one of your peers, KPIT, actually raised the full year constant currency growth outlook to 37% from 27 to 30% earlier. Would you want to do the same, given that the environment is similar? And if you can just tell us what kind of sustainable revenue growth would you be looking at?
Well, we have a great deal of respect for KPIT, and one of the things that we benefit from is that organizations like KPIT and LTTS and Tata Elxsi have really legitimized this space over the last couple of years. We continue to see strong demand. We continue to be successful in terms of large deal wins, and we're expecting a relatively strong finish to the fiscal year. I signaled at the end of Q3 that we are seeing somewhat of a runoff in one of our key customers, VinFast. They are transitioning from investing in new vehicles to building and selling them, and so we're repurposing the resources that are coming off that engagement, but it's not impacting our growth, and so we are a project-based company, and as a result, we are equipped and experienced in terms of dealing with the ebbs and flows of the various engagements that we're involved with. But if we step back from the specific customer situations, the momentum continues to be strong, and we are again expecting a very strong finish to the end of the fiscal year.
Can you give me one update on what's happening with the aerospace vertical? Because you have spoken about that being a big growth area for you. Any kind of visibility that you have there?
Yeah, I messaged again earlier this year that we have completed the accreditation work that we've undertaken for Airbus. This second half of this year has started to see us discharge the very sizable order book that we've built at Airbus. And we expect to see material growth in terms of that relationship next year. I think at a macro level, aerospace continues to be a very exciting space for us globally, and very specifically here in India. If you look at the demand for aircraft over the next 10 to 15 years, I think growth will be focused on Asia, and specifically India. And I think there's a massive infrastructure opportunity here in the country. And the Tata Group has already signaled that it intends to be at the front end of that. And I think the announcements that have been made in and around the C295 and the helicopter deal that has been announced between the Tata Group and Airbus specifically is a signal that there's a significant amount of investments that are going to be made here in this country. And as the only accredited aerospace engineering service provider, we expect to be able to take advantage of those tailwinds and use that to accelerate our growth.
Very quickly, Warren, before we let you go, I wanted a quick word on VinFast. You know, the revenue is a little bit weakish in the past quarter. I think quarter four could be a little bit subdued as well. My question to you is, does VinFast bottom out in quarter four? And if you could give us a brief idea of how much does it contribute to your total revenues?
Well, in previous quarters, it's been a material part of our revenue mix. In Q4, it will not be, and so that positions a very solid baseline from which we expect to grow in FY25. But what I would say is that we are very proud of the work that we've done at VinFast. It's a relationship that is very strategic and important to us, and as VinFast transitions to selling vehicles effectively in different parts of the world, we expect them to redouble their commitment to investing in new products, and we very much expect to be part of the ecosystem that they mobilize to enable that.
All right, we leave it at that. Thanks a lot for joining in. That's Tata Technologies with the outlook on 2024, how things are going to shape up from them, how deal wins are looking, etc. Let's slip into a quick break. On the other side, Rahul Mithal of RITES will be joining in to talk about their tie-up with Abu Dhabi Ports Group for Logistics Infrastructure Development. Later, we'll connect with Patanjali Keswani of Lemon Tree Hotels to talk about their new hotels and the business outlook, given that travel is booming. Stay tuned for more on that.
Welcome back. Well, the Nifty Bank has actually seen a big up move in the last few minutes. I think that index is calling for attention, and a couple of stocks have really taken off. Kotak Mahindra Bank as well as ICICI Bank, both of them moving to the high point of the day. Add in there HDFC Bank as well. You know, the bank Nifty itself, big up. You know, I think it's close to around 350 points from the low point of the day. But as promised, let's get a chat going with the management of RITES. They have collaborated with Abu Dhabi Ports Group for logistic infra development. Both companies have signed the MOU to explore JVs and collaborations in trade and logistics. Mr. Rahul Mithal, the chairman and MD of RITES, join us on the show. Hi, Mr. Mithal. Thanks so much for joining in. Could you quantify the potential of this particular tie-up?
Morning. You see, this is a significant step in our strategy of, expanding globally across geographies. And this was a natural partnership between two huge giants in their own field. AD Ports has been in areas of ports, multimodal logistic parks, infrastructure, etc. And we have a presence both domestic and internationally in all areas of infrastructure. So this was a natural partnership, and I think this MOU will give us a huge opportunity, not only in the UAE, the upcoming IMEC corridor, as well as geographies across Middle East and including geographies in Southeast Asia and Africa, where AD Ports is operating in more than 40 countries.
Okay.
So you want to give us a number, sir?
You
The
see, this is
potential?
this MOU has been signed recently, and this is covering a large number of areas. So this is it will give us opportunities to collaborate in various sectors, and the coming weeks and months will show specific orders or specific areas where we collaborate together.
But I think we're trying to get at a number because, your current order book is somewhere around 5,500 crores. If you can just help us with some ballpark number on how much this MOU could maybe add to your revenues over the next couple of years. How much can you build on to your current order book?
You see, this MOU is an agreement, is a partnership which will explore the various opportunities in various geographies, as I said. Each case, each opportunity, depending on the size of the consultancy order, the size of the infrastructure which AD Ports would invest in and take our help in the consultancy, would pan out in the coming in the months and quarters. Obviously, as you can appreciate, considering the huge opportunity and the geography that they operate in, and our presence not only in Southeast Asia but Africa, these numbers would be large. But I think it would be premature to speculate on specific numbers. And as and when these specific orders mature in the coming quarters, we'll be sharing that with you.
Okay, all right. Mr. Mittal, we've also heard of an India, Middle East, Europe railway corridor. What role will you be playing in that?
You see, as I said at the outset, the IMEC corridor is a significant, upcoming logistic corridor where our role as a consultant, both at the India end as well as now with partnership with the AD Ports in the Middle East, we would work together in trying to design, trying to help in consultancy in developing this corridor, both at the Indian as well as the Middle East, right up to the Europe. Whether it is the ports, whether it is the feeding rail corridors, whether it is the other infrastructure, the digital infrastructure. So our partnership would extend to developing this corridor right from one end of our ports to the European end.
I'm sure you understand that, we are pushing you to give us some numbers because if you look at the last 5 quarters, your revenues have fallen year on year. So there is definitely some concern that shareholders have about why the revenues are under so much pressure. Hence, we're asking you for numbers. When do you see a recovery in terms of the top line? When do you think you can get back to double-digit growth?
You see, when we started this FY, the two main challenges which we had was our export order book, depleting to literally zero since we had got no fresh export orders in the last about 3 to 4 years, the COVID period and post-COVID. And there was a significant impact on the consultancy of inspection, the inspection stream of revenue from Indian Railways as they opened up to 4 vendors. So this was the challenge at the beginning of this FY. And if you see our last quarter, quarter 3, sequentially, if you see Q2 to Q3, we have achieved 2-3 major milestones. One, we got our first order of about 300 crores from Mozambique for 10 locomotives. Our revenue grew Q2 to Q3 sequentially about 19%. Our EBITDA grew by 30%. And we could tap a number of vendors in the QA stream to, mitigate the impact of the hit from the IR as a client. So as these, and another major milestone, we could achieve our vision of being a 1 order a day company. We got 100 plus orders in quarter 3, totaling to more than 600 crores. So as these orders mature into revenue in the coming FY, we would see a substantial growth in our EBITDA vis-a-vis our baseline of 22-23. And 23-24 would be a year of consolidation, trying to reach as close to 22-23.
Okay, all right. What about, there was a Zimbabwean order also, I think, of around 850 crores, but there's political turmoil out there. Could you tell us what is the update out there and when can you expect the final LOA?
You see, we signed an agreement with Zimbabwe a few months back, and we did not add it to our order book, as you correctly said, because we were waiting for the final clearances of the funding. It's moving in the right direction, and we are hopeful that it should mature in the coming quarter 1. Parallelly, we have been declared L1 in a Bangladesh 200 coach order. This was a global tender for about 900 crores. And we are hoping that it will mature into a finite LOI in the coming weeks.
Right, so got that. So by Q1, we should be hearing about that Zimbabwean order. And I think the quantum was around 850 crores. So we'll wait by for that. Also, the market got very excited when it understood that RITES is in talks with Latin American countries like Chile to export Vande Bharat trains from India. Could you tell us, is there any conversation on that front? What stage of the conversation are we at?
You see, as I've been saying, Vande Bharat is a world-class product which is definitely evoking interest, especially in few Latin American countries, because the gauge, the broad gauge, is common to our gauge. So it's easier to customize the product for their network. And we've been in touch with Chile and other 2-3 Latin American countries. We are looking at some finite movement, but as I said, these are early days because they already have a certain type of rolling stock being used. We're trying to induct this as an introductory rolling stock. And we are hoping that we should be able to see some positive movement in the coming year.
All right. We'll leave it there, sir. Thank you very much for your time. Great speaking with you here on CNBC-TV18, and good luck. Hope to have you back again soon. Well, the market on the Nifty is down just 20 points, but the overall sort of broader market, that's the problem. And let's just put up the advanced decline ratio. In one snapshot, it'll tell you what's going on. 400 stocks are up, 1,800 stocks are down. The broader market losing momentum is the theme for the last, I think for much of this week. It's a truncated week with Friday a holiday, but I think it's been happening now for the last 3-4 trading sessions, if not a bit more. But one space which is not seeing any deflation, is seeing inflation, is hotels. We're talking about Lemon Tree Hotels next. Aggressive sort of addition to their room inventory, newer cities, of course, hotels coming up. There's a lot to talk about really in that space. Patanjali Keswani is Chairman and Managing Director at Lemon Tree Hotels. Mr. Keswani, good morning. Great to have you with us here. Thanks very much for your time. Prashant this side. Again, as I said, it's boom times for hotels broadly, and you've been doing very well as well. Could you give us a sense of what the fourth quarter is panning out like, Jan to March so far? Is it as strong as what you saw in the third quarter? And we recently had the management of Indian hotels, and I asked them what kind of increase in average room tariffs they expect to see in FY25 based on their assessment of demand strength. They said double digit should be possible. Actually between 10 and 15%. So I wanted your thoughts on the same as well. Go on.
So Q4 is traditionally better than Q3. And that's for a very simple reason, because I'm talking because Diwali and Dussehra are normally in Q3. And at that time, business travel and a fair amount of travel reduces. So yes, Q4 will be better than Q3. As far as next year goes, yes, I would agree with what you just said. I reckon that next year but the change really happens in October because that's your normal rate cycle. So I would say, yes, it will be north of 10%.
So average room rate should be 10% plus in FY25 over 24, as you see it right now. Sir? I think
it's frozen.
I think we have a bit of
as you know, we've opened a very large hotel in Bombay.
Yes.
Where the average rate will take the company's average rate up. So for us, it'll be a little better than 10%.
Okay. No, got that. Actually, so Bombay is a booming market. We got that feedback from Indian hotels as well. Could you tell us what is the tariffs there and what kind of occupancies are you seeing in the Mumbai hotel? The new hotel that you've opened, sir? What kind of response have you seen? What are tariffs, etc.? Okay, I think...
So
back.
Okay.
Okay, I think what we'll do is we'll try and have Mr. Keswani on another line because there's some technical issue.
I know you're very interested in the new hotels and the tariffs and everything, but it's just a scratchy line that we have.
No, Indian Hotels told us that the new hotel, and by the way, for Lemon Tree, it's one of the largest properties in Mumbai, and Indian Hotels told us the average room tariff is 7,500 rupees, and already with only a month old, occupancies are about 80-90% is what they'd said. So.
But surprisingly, they don't have a hotel in some of these temple towns, right? Ayodhya, etc. So I wonder why. I mean, Lemon Tree, that is.
Maybe in the works.
Maybe in the works, yeah.
Just a quick word on markets while we wait for Mr. Keswani to come back. And maybe because the market breadth is so negative, just take a look at the stuff which is coming under some pressure. Look at MGL. It started 8% lower. Nimesh was telling us that City downgrade. It's a 12% cut, 13% cut now on MGL. So that's a very large move there. IGL, which started about 3.5% lower, is down full 6%, and very large volumes. Manappuram is down 6%. That was also started about 3% lower. So cuts have become larger across the board. Zaggle, which has had a one-way up move, I think for the year it's up 75%. You minus today's 5 because it's down 5% right now. So 344. There's PNB Gills, which is down 5%. And Balaji Tele and a few others coming under some pressure as well. Zomato, of course, is the biggest volume mover, but there's a big block, which, as we highlighted, has gone through 158, and there the stock is taking a 5% knock as well. Okay, I think while we do we have Mr. Keswani? Okay, I think we have Mr. Keswani back. Mr. Keswani, apologies, we got you on a bit of a scratchy line. So I was just asking you about the property in Mumbai. You said that will take your overall room rates higher. Could you talk to us about what kind of occupancies have you seen so far, and what are tariffs there?
So look, it is the largest hotel in India, by the way. So it will take a little time to build up occupancy. We will, since it's close to 700 rooms, we are doing north of 400 rooms today. That's where we've reached. Roughly half the rooms are crew, and the other half are non-crew. So if I exclude crew, which is normally at a lower rate, our average rates there are about 11 to 12,000. My expectation is that this hotel will have a material impact because it is so large and so high value. It will have a material impact on Lemon Tree's overall revenues and average rates and EBITDA, which will start playing out from the next year. But in Q4, it will certainly do north of 60%, maybe 65%, and will be EBITDA, definitely EBITDA positive and also PAT positive, which is actually quite exceptional when you open a new hotel.
Absolutely. Mr. Keswani, good morning. We were just talking about how there is this sudden surge in religious tourism. Wanted to understand, do you have any hotels in these temple towns and any plans for opening a hotel in Ayodhya?
Yeah, so, well, I was not going to say anything till we signed, but we have a definitive agreement to open a 200-room Lemon Tree Premier in Ayodhya, very close to the, what is it called, the temple complex. And we also have, we are in the middle of discussions to open an Aurika in a palace on the banks of the river Ganges with its own private ghat. And I expect that both of these we will finalize and then obviously inform the stock exchanges once it's final in the next 3 months. In addition, we have, as it happens, a whole bunch of hotels in what we would call religious destination locations, especially in North India, in Rishikesh and so on and so forth. So we are quite present, but actually I'm quite happy about the Ayodhya and the Varanasi, Kashi projects. They are large projects, very nice projects, and significant capital will be deployed by the people who own these assets. We will be managing them.
Okay. Mr. Keswani, got that. So, in terms of new room addition, by the end of this year, what would you be at? And by the end of next year, because you've got so many plans, FY25, where will you be at?
So currently, Prashant, we have about 10,000 operating rooms, about I think 101 or 102 hotels. We have in the pipeline roughly another 3,500 rooms and about 60 hotels. So these will obviously operationalize over time. My best guess is every year we will open at least 2,000 more rooms and we will add 3,000 more rooms. So if I gave you an estimate, next year we will have over 12,000 rooms operating. We will probably have 4,000 rooms in the pipeline. Then the following year we will have 15,000 rooms operating and maybe 5,000 rooms in the pipeline. What I had broadly said was that over 5 years, I said this last year, we will hit or exceed 20,000 rooms.
I see. I got that. 20,000 rooms, basically in the next 4 years now, right? Because you should be there every year. 2,000 rooms. Yeah.
Yeah. Basically, we already are in that sense because this 20,000 includes hotels yet to open. It's the pipeline. Yeah. So we are already at nearly 14,000. So it's not an ambitious target at all. What I'm saying is every year we will sign 2,000 more rooms, and obviously some of them will continue to keep opening.
Got it. Mr. Keswani, we'll leave it there. Shorter conversation today, sir, and hope to have you back on a proper line next time. Apologies for that scratchy one. Thank you for joining us. Useful conversation as always. Well, we'll just quickly turn back to the market once again. Mitesh is with us. So the broader market is what I was referring to, a fair bit under pressure. Mitesh, what would you make of it?
So Prashant, I think there's good amount of divergence which I can spot between the Nifty and the Bank Nifty. The Bank Nifty still looks strong to me, but if you look at the other components of the Nifty, which is your IT and FMCG, etc., I think that's where selling pressure is coming in. So explore some shorting opportunities in those spaces. I have a sell on Marico with a stop at 511 for targets of 490, and HUL is also on the negative side, sell call. Recommended stop is about 24.15 and a target of 23.50 can be looked at.
All right, let's slip into a quick break on that note. On the other side of the break, we'll put focus on the commodity space with Manisha Gupta. Do stay tuned in. Welcome back to Bazaar Corporate Radar. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at metals as a sector, which is slightly bearish today after the Chinese important National Congress meeting got over, and they have put a 5% GDP target for 2024. It's the same as put for 2023 as well. And then the statements read out various pledges and promises for further support for the economy. But there wasn't a concrete statement in sense of numbers, targets and timelines, and that is what the street does not like. In any case, the data has been on the weaker side that has come in from China. So whether it has been about service sector, which saw less than what the street was anticipating for the month of February. Manufacturing data has continued to decline for 5 straight months, including for the month of Feb as well. I'll come to metals direct and for copper as well. When you look at Chinese inventories, well, they have continued to gain up. In the matter of this year itself, it has been nearly 100% of an increase in inventories, and it stands at a one-year highs of more than 214,000 tons there. The interesting trend shows in LME warehouses, where you have seen a decline of 38% in sense of inventories in this year itself at around 114,000 tons onto that one. Nearly half of what Shanghai is holding in sense of copper there. So there are arbitrage opportunities which the street is looking at, and some pressure continuing from China. What the pressure really is seen is in case of ferrous metals. So the construction metals continue to be on the weaker side. Steel, for example, is trading at a 4-month lows. We are trading in the negative on weekly and monthly basis as well. Iron ore prices are trading at a more than 4-month lows as well. So pressure continues on that. The port inventories are on the higher side. Australian exports also jumping up. So that's keeping the prices in check there. Nickel prices have come off the 4-month highs that we saw onto this one. Zinc is near trading at 1-month highs there. The LME inventories in zinc also are at a multi-year highs, and that is keeping the prices in check on that one as well. I want to take you through on what the prices have been in the last 1 week, and this chart will clearly show you that the most major declines clearly coming in for construction, infrastructure metals. So iron ore and steel prices in the matter of last 1 week have been down by 3 to 4%. The non-ferrous metals, by the way, 0.5 to 1.5% of gains is what we are seeing. But these also have come off the kind of highs, and we are trading at around the lower side of the range for these.
All right, Manisha, thanks very much for that. The market's taken a bit of a dive, by the way. We're down 80 points. The Nifty will come up, and I think it's materialized pretty fast in the last, 5 minutes or so of trade. Yeah, so we were at 22,370. We're at 22,287. In short order. We'll take a break here. We are back on the other side. Our special segment is the economy. My colleague Lata will get chatting with DK Joshi of CRISIL, Miriam Loda of CRISIL as well, to talk about the report on India's year and the decade ahead. CRISIL's assessment coming up. Stay tuned.
Welcome to It's the Economy. Rating agency CRISIL, in an electrifying recent report, sees India emerge as an upper middle income country by 2031 with a per capita income of $4,500 and overall GDP size of nearly $7 trillion. So what's CRISIL betting on, both in the near term and in the medium term? I have with me the two authors of the report, D.K. Joshi, the chief economist, and Miren Lodha, the director research at CRISIL. Gentlemen, thank you very much for joining me. Well, D.K., it's good to hear that 4,500 and upper middle income country status. But before I come to that, the near term, you have a 6.8% growth forecast for FY25 itself. Reserve Bank is already talking 7. What makes you a little cautious about next year?
Well, there are three factors which will drive the growth down. It's not a slowdown. 6.8 is a reasonably
damn good number,
I think, from what's happening globally. One is the interest rate hikes. RBI raises interest rates to bring inflation down, and before inflation comes down, they bring growth down. So that is the route. Yes. And we've already seen transmission improving over the last couple of months. The second reason is the fiscal impulse, which is the fiscal deficit is lower as a percentage of GDP. So the fiscal push is somewhat lower than what it was last year. And the third reason is more technical in nature, which is the net taxes. You got an unusual lift this year, which is unlikely to play out in the coming fiscal year. So combine all these three things, you get a mild moderation in growth, I would say.
Yeah, absolutely. But let me just persist. You know, last year, RBI began with 6.5, and all of you were closer to 6. But RBI itself has scaled it up to 7.6. What are the chances of, an upside surprise in the current year as well? Actually, the same thing has happened in the US. They also have faced upside surprises.
Yeah, there is always a chance of upside. I think the upside could come from agriculture because you've got a very anemic growth of 0.7%, and you will get a pretty high rate of growth if the monsoons are normal. So that could be one upside. The second upside can come from the performance of the US economy. I think, don't forget, it's our largest trading partner. We export hell of a lot of goods and services both. So that is a positive development for us. So there are some and if the private capex becomes stronger, I think, particularly post-elections, I think that will also help. So there are reasons to believe that there can be an upside, but we are going by what we believe is the base case.
Okay. No, actually, on that point, let me get to Miren. Miren, before I ask you about the private capex picking up, how will corporate India's revenues grow? Is it going to be a good year of growth? Will you have margin advantage? How commodity prices, we are told, are going to fall. Are going to be on the back foot next year.
Yeah. See, I think financial performance, we are expecting one more strong year. On revenues, we are possibly expecting 100 bips higher growth compared to fiscal 24. So we'll touch the double-digit territory. So we're expecting somewhere close to 10% revenue growth for corporate India.
Okay.
On the margin front, we're expecting a higher improvement, closer to 100-150 basis points.
Okay. So that means earnings growth will be very good.
Yes.
Okay. It should be.
We look at EBITDA margins, but yeah, I think given that the deleveraging has happened, I see a lot of it flowing to the net level as well.
Okay. Well, let me come to the more important question of capex. Until now, the government capex has done most of the heavy lifting.
Yeah.
Are you already seeing signs of private capex, and how may it do in 25?
So at least in the conventional sectors, which is the traditional sectors where we had a large manufacturing presence, we've seen that pick up. Last couple of years, I think the private capex would have grown around 10-12%, which is a good number. But more importantly, I think next 4-5 years, we're seeing a huge leap up. So from roughly around, currently we do around 3.9 lakh crores per annum on an average. We're expecting the bump up to be around 6.5 lakh crore rupees. A lot of this would be driven by the emerging or the new age sectors where traditionally we've had very little or negligible presence.
EV, semiconductor types?
Yes, the 3 E's, that's what we call them.
Which is?
Electronics value chain, which includes semiconductors. The second is your EVs. which includes batteries. And the third is energy transition, largely the solar PV modules.
Okay, fair. Good to hear that. But DK, how worried would you be about consumption? I mean, capex has done well, government capex has done well, and as Miren says, there's a very good chance that you will also see private capex pick up. But if consumption in the current year at 3.5 continues that way, will investments come? I mean, ultimately they respond to consumption, don't they?
Well, I think I would be worried about consumption, because if you take a historical view, I think back in the 50s, 60s, consumption used to be a very large part of GDP. And then I think it started coming down because investments started improving as a percentage of GDP. And we saw stability in consumption to GDP ratio. So this year it's actually very anemic growth. But I would say that it can still be revised, because this is obtained as a residual, and I think there's always a chance of improvement.
Higher.
And I think maybe it's also possible that the newer types of consumption, because your base is so old, you're not able to capture that. That's also a possibility. But I think the consumption has been a mixed bag. I mean, where we can track, it's very clearly visible that the higher end of items, whether it's houses or it is automobiles, etc., their consumption is rising. I think what we don't know much about is the lower strata, I think. So
FMCG companies tell us that volumes are as low as 2 and 4%.
See, India is a domestic demand-driven economy. I think consumption is its bulwark, 57% of GDP. So I think the consumption story has to continue. And my sense is it's going to continue, because if per capita incomes rise, you will see consumption again increase.
Okay.
I just have a point to add there. So even in the consumption narrative, I think there's a split that we're seeing. So one is the premium goods. The demand is pretty good.
Yes.
Whereas in
premium homes.
Whereas in mass market, large-scale consumption goods, you're seeing actually a flat or a declining trajectory. So there are two divergent trends playing out there.
Okay. No, that's a fair point. Now, for the medium term, you're forecasting a 6.7% growth up until 2031. Okay, CAGR. Now, we've never had a long period of growth. We do 7-8% like we did between 2004 and 2008, and then we get one bad year. Likewise, in the next decade, we didn't have such a long stint of high 7% plus growth. What makes you confident now?
Well, I think, first of all, I want to make a point that we have a track history of high growth. I mean, it's not that. For the 3 decades before the pandemic, average growth is 6.2%. It's reasonably high. It's not like China, but it's reasonably high. And now I think what's happening is that you have 2 drivers of growth coming in. I think one is clearly the balance sheet strength, which whether it is the banks or it is the corporates, that allows you to enter into an investment cycle. The second, I think, as Miren was saying, I think government has been investing. I think they will continue with their investments, but not at this pace. But the private sector has to now chip in, and we're seeing some signs, as he was also mentioning. So we see capex driving growth. So capex cycle hasn't picked up for a long time, and now it's been on an upturn for the last 3 years. So I see a lot of potential for it to go up further. So that is one. Second is the efficiency. You're creating infrastructure, and physical and digital. Connectivity is improving, turnaround times are are shorter, so you have enough data to show that. And digital infrastructure is allowing a lot of efficiency gains in terms of payment systems. It's also allowing, I think the government is saving money when it transfers money to poor through direct benefit transfers, and it's also a platform for innovations. I think all these applications like CoWIN, etc., they all erupted because of that. So I think that itself is helping. Now, I don't remember any other country developing its physical infrastructure and digital infrastructure at the same time, I think simultaneously. So there are synergies that are possible out of this, and we are already seeing that. A very rough example is that the roads. You've constructed roads, and now you've also GST via GST.
FASTag.
Yeah, you FASTag. You've eliminated the octroi. Now this time that you spent on the toll is much lower. So you're saving energy. So now you add these up across the nation. I think so this is only one example. And through smart metering, you are also saving your electricity leakage. I mean, leakages are much less. So I think the digital and physical Synergy will also allow you to grow faster, because I think there are three drivers of growth: capital, labor, and efficiency. So what if efficiency is going up, it means that with the same amount of capital and same amount of labor, you are able to grow faster. And here I think the sad part is that labor doesn't contribute much to growth in India, but that's a different story. But capital, we are clearly seeing it contributing more now, because you are creating capital which also spills over to the private sector, which is when you build road, there is more opportunity for the private sector to come forward. You'll sell more cars. I think the efficiency, logistics will improve. All those are visible. So it's moving in the right direction. So I think confluence of these things is making us believe that we can
have a consistent record of
6.7% for at least till the end of this decade. I think that's how far we can see as of now.
Fair point. Miren, I want to ask you, what do you see as advantages because of the lower yields? I mean, we've just got news that India is getting included in the Bloomberg Emerging Market Index as well. It's not a great deal of money. It's only 3 billion, perhaps, or $4 billion. But the point is yields. I mean, how do you see that shape up with bond index and fiscal prudence coming in? And will that be a big accelerator for investment?
Yeah. So I think more than an accelerator, I think it's an enabler. So, we don't see a constraint, at least on the funding side. That's how I would like to see that. Both from a banking perspective and a bond market perspective, I think there'll be enough support to ensure the private sector has access to investments which they require. If you look at the emerging sectors, a lot of the borrowing would be by the larger corporates, which could be in the nature of bonds. So there'll be disintermediation there. Rather than borrowing through banks, they would directly access the bond markets, which is where I think what you asked, the yields will definitely play out and will support. But again, a small improvement in yields will not necessarily determine the investment decision, correct? It's the other way around. But there's enough support to ensure.
Financial support is there for capex plans.
Yeah.
But let me, now running out of time, what do you think can go wrong? Where are the red flags?
For the growth?
Yeah,
I think
for the excellent growth story that you
One is that I think we've seen resilience to global shocks. And I think if the global shocks increase, we are very, very vulnerable to oil. I mean, if oil, so that is one external risk which we can't avoid. I mean, we are too dependent on oil. The second, I think, could be, I think it's generally speaking, complacency. I mean, you're doing well, you'll do well. You need to accelerate that, keep the pedal on the reform side so that you are able to grow faster, I think. I think these are the two risks that I see. Weather is always a risk. Climate is always a risk. And I think no target comes without risks. So
yes, absolutely.
A lot of these shocks could actually emanate from geopolitics. So that's what we need to keep in mind.
That's a fair point. Yours is an excellent 75-page report, and I have not been able to do justice to a lot of sub-themes. Miren, why don't you tell our viewers what will be the one or two sub-themes that the report speaks about?
See, one, I think, is the corporate financial performance. It's going to be excellent. I think from a revenue standpoint, we'll have fourth consecutive year of healthy growth, not seen in a decade. Profitability, we hitting almost a decadal high, going back to pre-COVID levels. From a input side, there's easing of commodity prices. Whether you look at crude, we are 34% off the peaks that we've seen recently. Steel, we are almost 25-30% off. So these are some of the
juicy things
yes.
Which you are explaining in your report. I think you have said all the right things for a stock market audience. Revenues, margins, cheaper raw material prices. But I take on board, DK, the caution that you are saying that we don't get complacent and we continue to improve what you called ease of doing business, removing the roadblocks, the judicial, legal system, and those kinds of roadblocks to growth. Looks like 7% would never be a given unless we work.
No, I think don't forget, India is starting from a low base. It has a huge opportunity to improve its growth by doing little things. I mean, which countries like China can't, I mean, they can't increase their investments. They're already at the peak of efficiency. India has a lot of opportunity right now. It's starting from a low base. It can continue to grow faster for long.
Great to hear that as we stand on the threshold of a new financial year. And there are several things coming together. There's an election which promises both political and policy stability in the next 5 years. So we are standing at a very interesting inflection point. On that positive note, it's curtains on this edition of It's the Economy. After a break, it will be time for Chartbusters.